Hey everyone, today we're talking about dividend stocks. Now, dividend stocks are a great way to generate passive income from the stock market. What I mean by passive income is that you'll receive a portion of the company's profits without having to actively sell or buy the stocks. This can be a great way to make money without having to constantly monitor your investments. So, when you're looking to pick the best dividend stocks, the first thing you should look at is the dividend yield. This is the amount of money that you'll receive in dividends per share of stock. The higher the dividend yield, the more money you'll make. Now, there are a few different ways to calculate dividend yields, but the most important thing to remember is that a higher yield is better for you. Dividend yield is a financial metric used to measure the amount of income generated by a stock, expressed as a percentage of the stock's price. It represents the annual dividend payment of a stock, divided by its current market price. The formula for calculating dividend yield is dividend yield equals annual dividend per share, stock price. For example, if a stock has a market price of $50 and pays an annual dividend of $2 per share, its dividend yield would be 4%. 2 divided by 50 equals 0.04. Dividend yield can be an important factor for investors looking for income from their investments. A higher dividend yield typically means that a stock is generating more income for its shareholders. However, it's important to remember that a high dividend yield can also be a red flag, as it may indicate that a company is struggling and may be at risk of reducing or eliminating its dividend in the future. It's important to understand that dividend yield is not the only factor to consider when choosing dividend stocks. Other important factors to consider include the stability and growth of the company, its financial health, and the sustainability of its dividend payments. It's also important to keep in mind that the dividend yield of a stock can fluctuate over time based on changes in the stock price and the amount of the dividend payments. For example, if a stock's price increases, its dividend yield will decrease, and vice versa. In conclusion, dividend yield can be a useful tool for evaluating a stock's potential income, but it's important to consider it in the context of other factors, such as the company's financial health and future growth prospects. Another important factor to consider when picking the best dividend stocks is the dividend payout ratio. How to assess the company's payout ratio? Calculate the company's payout ratio by dividing its dividends per share by its earnings per share. A ratio of less than 50% is considered healthy, as it indicates that the company has enough earnings to cover its dividend payments and still retain earnings for future growth. The payout ratio is the proportion of earnings paid out to shareholders as dividends. It is calculated by dividing the dividends per share, DPS, by the earnings per share, EPS. A low payout ratio, usually less than 50%, is generally considered healthy, as it indicates that the company is retaining a significant portion of its earnings for reinvestment in growth opportunities or to strengthen its balance sheet. This means that the company has a cushion to weather any economic downturns or unexpected expenses, and also has room to increase dividends in the future. A high payout ratio, usually over 70%, may indicate that a company is paying out a larger portion of its earnings as dividends and may have less room for future increases. It could also be a sign that the company is not generating enough profits to sustain its dividends in the long term. It's important to note that payout ratios can vary depending on the industry. Some companies may have a higher payout ratio than others because of the nature of their business. For example, utility companies tend to have higher payout ratios compared to technology companies. Additionally, it's important to keep in mind that the payout ratio is a backward-looking metric. It gives an idea of how much of the past earnings were paid out as dividends. It's important to combine it with other metrics such as cash flow and revenue to get a better idea of the company's future dividend-paying ability. Finally, you should also consider the dividend growth. This is the rate at which the company's dividend payments have been increasing over time. A higher dividend growth rate means that the company is increasing its dividend payments, which is a good sign. It indicates that the company is doing well and is likely to continue to increase its dividend payments in the future. Dividend growth can be measured by comparing the current dividend payment to the dividend payment from the previous year, or by calculating the average annual dividend growth rate over a period of time. A company that consistently increases its dividend payments over time is generally considered to be a reliable income investment, as it suggests that the company is financially stable and has a strong business model. Investors typically look for stocks with a history of consistent or increasing dividend growth. as these stocks are often seen as a good source of long-term income. A company's ability to grow its dividend over time is often an indicator of its financial strength, as it shows that the company is able to generate enough earnings to not only maintain, but also increase its dividend payments to shareholders. It's important to keep in mind that dividend growth is not the only factor to consider when choosing dividend stocks. Other important factors include the stability and growth of the company, its financial health, and the sustainability of its dividend payments. In conclusion, dividend growth can be a useful metric for evaluating a company's ability to generate income for its shareholders over time, and can be an important consideration for investors who are looking for a steady and increasing income stream from their investments. So, there you have it. When you're looking for the best dividend stocks, remember to look at the dividend yield, payout ratio, and growth rate. If you do your research and pick the right stocks, you can make a lot of money from dividends. Thanks for watching. And don't forget to hit the subscribe button.